So the first topic that we have got is with regards to mission statement. How would you define what are the aims for any business, anybody who is doing business and anybody who is not even in corporate business, otherwise as well, people, they define aims for the activities that they carry out. Agreed?
Yeah.
So for businesses, it's simple. For business, whatever they want to get out of their business, that is defined as the business aim, the larger picture, the larger goal that they want to achieve, maybe not in a day, but in the long run, that is their business aim. Then this business aim, they try to codify that in the form of mission statement. Okay, so what are the components of mission statement, or what should be there in the mission statement, and what purpose does a business mission statement serve?
It makes like a path that the business should follow, and like motivation.
Okay, so the mission statement, it has some benefits for the business and it has some benefits for other stakeholders outside the business. For the business, it serves the following benefits. So for example, it quickly informs the stakeholders of the business, about aims and vision. Okay, and then the other purpose that you mentioned, what else does it do? The mission statement.
Motivation.
All right. It can, for example, the mission statement. One, it can motivate the. Oh, all right. Let me write motivate the employees. How did it motivate the employees?
Maybe it gets the employees excited about the end goal.
Okay, when the employees, they are able to see what part they are playing in the organization and how does it connect to a larger aim that is being achieved by the organization, that is the thing that would motivate the employees. So when employees, they see whatever part they are playing in the organization, how it gets connected to the larger overall aim that the organization is achieving, that thing would motivate the employees. It could also give the moral direction, or it could give benchmark slash standards for employees to follow. Okay, the mission statement, it's not detail oriented. You're not given a lot of detail in the mission statement. You're not given detail of how the organization would go about carrying out its day-to-day activities. You're just given the larger picture of the organization. So for example, here I've got three different organizations. You're aware of Nestle, right?
Yeah.
So the Nestle, they have got the mission statement as good food, good life. They believe that if they provide good food to people, it would give them a chance to have a good life, and that good life is what the good life for the masses in general. That is what they wish to achieve. Okay. Similarly, there is this Microsoft. Microsoft says that our mission is to empower every person, every organization on the planet to achieve more. What we are doing, what products we are creating, we want through these products for people to be able to achieve more. Our products, they should enable the people, it should give them the power to achieve more. Tesla, you're aware of all these companies, you're aware of Nestle, Microsoft and Tesla. So Tesla, they said they want to accelerate the advent of sustainable transport. Okay. If you see the other businesses that this person is engaged in, for example SpaceX, he is a lot about sustainability. The resources that are available on our planet, they are available in limited quantity. So the only sensible way of using these resources is to be aware that these resources, they would run out, and we have to, number one, use renewable resources, and if we are to use these resources, we have to recycle them, reuse them again and again. So this is what this particular organization, it is achieving towards that. We have to, for example, they are in the transport business right now, so they want to, that transport business, the way we transport around ourselves, that should be a sustainable way. Okay, for that they have produced the electric cars. Okay, so
Yeah.
this is with regards to the positive aspects of the mission statement. Other thing about mission statement is that it gives values, it gives standards and behaviors, and it gives a hint of the strategy. It gives a hint of the strategy, like what sort of, for example, Nestle Good Food Good Life, it tells us that they would remain in the food business, or they, all they will do will have something to do with the food business. This Tesla, since they mention the transport in their mission statement, it gives us that they, all the business, their business would be around either the transportation vehicles or the transportation network, but it will always have something to do with transportation. So it gives us a hint about this strategy as well. Okay, the next thing is that what could be missing, or what's the let's say criticism on these mission statements. On the face of it, it seems to be something good, that it, for example, informs the stakeholders, it motivates the employees, it sets direction, gives them benchmark. What could be missing, or what could be lacking about these mission statements in practice or in theory?
Takes a long time to create.
Okay, let's write that over here. You said it takes a long time to create. What else? We'll see if it's a valid point or not, but let's write it down. Takes a long time to create. What else?
Sometimes maybe it's not accurate because it doesn't have numbers.
Very good. Not accurate. We'll see. I'm just writing down your points. I'll mold them in a bit and tell you what's the criticism in a bit. Okay, what else?
Mm,
Tell me if you have reached your limit of coming up with points.
yeah,
Okay,
no more
okay,
points.
okay. So for the first thing, that it takes too long to create, that's fine. The reason being that it's something you can't change your mission statement every other day. Once
Yeah.
said, it just stays over there for 10, 20, 30 years, for as long as the corporate operates. Rarely they go about changing their corporate objectives or their mission statements. Not corporate objectives, the mission statements. The other thing is that it's not accurate. We'll write that in a different way. So the criticism on the mission statement exercise is, first of all, it is too vague. I mean, what do you mean good food, good life? What would be your contribution in it? There isn't enough detail in it.
Yeah.
Okay, so it could mean anything for any person. What exactly does the corporate means? That seems to be a vague thing. The second criticism on this mission statement is, they are mostly done, I mean, the criticism is that they're done as a PR exercise, public relation exercise, done as a PR exercise.
What's a PR exercise?
PR exercise is
You mean
some
public or?
public relations exercise. So
Oh, okay.
something that you do simply to please the public. You have
Yeah.
no real intention of actually following it up. I mean, PR could be that you are announcing something that you're actually about to do to the public, about to do. You announce this thing to the public as well. But the criticism on mission statement is that you just say it to the public, whereas in practice you might be doing something very different from it. So it's not practiced. That's the criticism. The third criticism on it is, the third criticism on this thing is that since it's vague, since it's very vague, it's really difficult to analyze or agree with. So organizations, they can always in one way or another prove that yes, we are following this, whatever we have written in the mission statement. And since it's a vague statement, you could mold it one way or another to always suit whatever you are doing. Okay.
Yeah.
All right. So with these with these mission statement out of our way, we have got a hierarchy of the way these things happen. So at the top we have got aims, and these aims, they are codified in the form of mission statement. Then this mission statement, based on this mission statement, the corporate sets its objectives. So we have got corporate objectives, corporate objectives, and then to achieve these corporate objectives, we have got these corporate objectives. They are broken down into departmental objectives, departmental or divisional objectives.
What does that mean?
For example, an organization, usually it's divided into a few departments. There is an operations department, usually that is the production department or the department that carries out the service, that the service or produces the thing that the organizations, that's for example in GSK, GlaxoSmithKline, their operations department would be the production department. They would be producing the products that eventually GSK sells, Panadol, Horlicks, Sensodyne toothpaste, and such other products. Okay. So for Nestle, the department which actually refines the milk, packages the milk, that would be the operations department. Then other than operations department, we have got marketing department, we have got finance department, we have got sales department, we have got supply chains department. So all these departments, they are sometimes called departments, sometimes they are called divisions. So when we set objective for corporate level for the overall organization, then based on that objective we tell each department that this is what the organization wishes to achieve and this is going to be your part in it.
Yeah.
All right, so that would be the departmental objective, and then these departmental objectives, they're broken down into strategies, and strategy is broken down into tactics. So
and what's divisional?
Sometimes we use the term department, sometimes we use the term division.
Oh, okay.
Okay.
Yeah.
So this is the hierarchy in which objectives are set within an organization. The thing is that these aims are very long term, and for example, this is the duration of time in which these are to be achieved. So below the departmental objectives, we have got strategies. We develop strategy or strategies to achieve these departmental objectives, and below these strategies we have got tactics. So tactics are what the actually sales force or the actual for example production people, the modus operandi at the very grassroots level of the organization, that would be tactics. And what they're trying to achieve through those tactics would be strategies, and those strategies would culminate into departmental objectives, which would then combine to form corporate objectives, mission statement, and aims. Are you following me?
Yeah.
Okay, so with regards to objectives, we say a thing, there is an acronym SMART, that the objectives, they have to be SMART. This stands for that they have to be specific, they have to, for specific we mean, for example, if,
Measurable.
very good, specific, measurable,
Achievable.
very good, achievable.
The last one is time something.
Time bound.
Forgot. Time bound, yeah. And the R is
Realistic.
realistic.
Okay, so A, sometimes some people say achievable, some people say agreed. It could mean either of the two. Okay, so for specific, whenever you specify, for example, you go about setting your objectives or you go about setting your aims, you have to be specific. For example, you say I want to be the best student. What does it mean to be the best student? I want to be the best food company. What does it mean to be the best food company? Be specific. That I want to be the food company which does not get ever involved in an ethics issue. I want to be a food company which provides good food to people as well as follows the best production practices. So be specific. The second thing for the aim is that it should be measurable. I mean, how would I measure, how would I check whether what you are saying that you want to achieve you will actually achieve? There should be a yardstick for measuring what you are setting as your objective. The third thing
Yeah.
is that they're agreed. It shouldn't be that in an organization, just the owner of the organization or the topmost managers, the CEO or the departmental heads, they think that this is going to be our objective. They have to sit down, they have to discuss this together and agree on it. It couldn't be that the finance department is focused on cost minimization, whereas the, let's say, sales department is focused on business expansion or sales maximization. The organization of the overall organization, the corporate objectives, they should be agreed, and the departmental objectives that we get, they should be in line with those corporate objectives. They should not be conflicting with those corporate objectives. The third thing is that all right, you have agreed, you have set a very specific objective for yourself. That objective can be measured and you have all agreed, but is it realistically possible to achieve this particular objective? Let's say the SpaceX, the other company that this person owns, what's his name, Elon Musk. Okay, so let's say they say that by the end of year 2021 we'll land human beings on Mars. It's not a realistic aim right now, because right now we do not have the technology for human beings to survive in that particular environment, or human beings to go over there and then make a safe journey back. The last thing with regards to these objectives is that they are time bound. Okay, that we have to achieve all these realistic objectives which we have set above, which we can measure, which are specific, by this particular time. So for example, a student says that I'll inshallah achieve A grade, and then he doesn't go on to achieve A grade, and then he said that I never mentioned that it's going to be this term or the next. The same way, you agree the, for example, a sales target with a sales department head. He said that the sales, it would grow 6% this year, and at the end of the year he said the sales would grow 6%, and at the end of the year you ask him it hasn't grown 6%, he'd say that I didn't say it would grow this year. So all the objectives that we have, they have to be time specific. Usually the organizations, they set long term and short term goals, but every year they go about setting the objectives for the next particular year. Okay, so this objective setting activity happens almost every year. Then there is that, what are the usual corporate objectives? What are the usual corporate objectives? First we will discuss this, and then we will discuss whether these objectives, they vary from big organizations to small ones. So if you could give me a list of a few objectives that various businesses have.
Like Tesla and stuff.
Generally in more generic term, rather than business focused, or like, what's the ultimate objective of any business? If you are into, if you were to start, very good. So the very first objective, the economic theory, it tells us that the first objective for any business is profit maximization. Not only to make profit, it's profit maximization. They want to make the maximum possible profit that they can. Profit maximization. Okay, we know, just a side note, that profit is calculated how? How do we calculate profit?
Total
revenue minus cost. So from the total revenue of the organization, I deduct all the costs and I will get profit. Agreed?
Yeah.
Revenue is sales. You can use the term revenue or the term sales. They mean to be the same thing. So if you want to increase your profit, you have to do one of the three things. You have to increase your revenue, you have to decrease your cost, or you have to simultaneously increase revenue and decrease cost. That is how you would increase your profits, right?
Yes.
Okay, so each year you see that how in this particular year I can increase my revenue, and how in this particular year I can decrease my costs. Okay, other than profit maximization, what are the aims of businesses or the corporate objectives of businesses?
Reach more customers.
Yes. So one of
expanding the company.
again.
Expanding.
Okay, so you mentioned two. One is increasing market share. So a business might have its aim that right now I'm not focusing on profit maximization. I just want to have more people buy my product. And once I get them to buy my product, once I've established my share in the market, then I'll build customer loyalty, and then I can charge differentiated prices or premium prices to these people, which can increase my profit as well. But right now my focus is not increasing profits, my focus is increasing market share. And you know how to calculate market share, right?
Uh,
Sales of a business, sales of business,
divided by market.
total market sales.
Yeah.
Total market sales into 100. Okay, and it depends that what sort of market share they want to increase. Usually this is in terms of volume, the number of units sold. Somebody might have this aim of increasing, that is usually called sales growth. So increasing market share, or it could be increasing revenue. So without increasing revenue, if your customers haven't got any alternate, you can increase, without increasing your market share, you can still increase your revenues by charging higher price to same people.
Mm.
And if those people, they do not have alternatives to switch to, they'll keep
Then
on
they
buying
will
your
buy from
products.
you.
They'll keep on buying your product, and they'll increase your revenue. So increasing market share in terms of volume and increasing sales revenue, they could be slightly different things. What else?
Oh.
There is something similar, growth. Okay, so for example, you want to grow your business, not necessarily that you grow in the same market. If you have reached the limit of a certain market, you can still grow your business by selling in other markets. Very good, very good.
Penetration.
So market penetration or market development? Market penetration is when you are selling more of the same, more of the product in same market. Market development is when you are selling the same product in new markets.
Yeah, market development.
So it would be market development. Very good. What else? There is another thing called profit satisficing. Profit satisficing. Are you aware of this thing?
No.
Okay. So profit satisficing is that a business might say that we want to earn profits. Eventually, we are talking about these objectives. They are usually set, or they are usually visible or available in case of public limited companies. For unincorporated businesses, which are not companies, those being the what are those? The sole trader and the partnership. The data isn't there altogether. I mean, it's mostly their choice if they want to make data or not. The requirement to produce financial statements in a particular format, they do not apply to them as much as they apply to corporate, the private limited and public limited companies. Agreed?
Mm.
Okay. Then in case of public and private limited companies, with private limited companies, the data is not publicly available. They have to submit that data with the authorities, but for the public consumption, that data is not available. Like what profits a private limited company is earning, I wouldn't know. Unless they voluntarily make it public, there isn't a requirement on them to make it public. On public limited companies, there is a legal requirement to like publicly publish their financial statements and show their data. Okay.
Yeah.
So all these things, they're available in case of public limited companies, the public information. The next thing is that when we are talking about big corporations, all these other forms of businesses, the unincorporated businesses and the private limited companies, they can only grow up to a certain extent. The bigger organizations that I've got, all of them happen to be public limited companies. All these companies that we talk about, Tesla, Google, Microsoft, Ambani Group, most of them, they happen to be public limited companies. Nestle, Honda, Toyota, their shares, even their listed companies, their shares are traded in the stock exchanges. Anyhow, so the point that I'm trying to make is that who are the owners of these public limited companies? Who is the owner of the business?
The
The shareholders.
Yeah.
those who own the shares. Okay, what do shareholders demand? What do shareholders demand from? Okay, the business, there is divorce between management and control of business. Business is controlled by shareholders, but it is managed by the managers, the CEO, the departmental heads, the managers. Agreed?
Yeah.
Okay, so what is the requirement of shareholders from these managers? So for example, if you were shareholder of a business and I am manager of my of that particular business, let's say our business is making shoes.
Yeah.
We make shoes, we have got a factory and we sell those shoes in, let's say, Saudi. Alright, we export from UAE to Saudi. Okay, so what would be your requirement from me being the manager of that business?
From you, the CEO,
Yes,
to
to make more profit. Since I am the one making all the financial decisions of the business, it's not the shareholder. The
yeah.
day-to-day financial decisions, they get made by the CEO. So the shareholders, they want the maximum return on their investment. They want the maximum profit. So with profit satisficing, the thing is that I, the CEO, asks the shareholder, I asked you, how much profit do you want? Okay,
Yeah.
so you give me a certain number of net profit. Let's say you say that net profit should be 5% more than last year, and it should be, let's say, as profitable, net profit margin should be, let's say, 7%. Let's just assume. Okay, you give me these two targets. I'll say, all right, I will make the net profit more than 5%, and I will achieve the net profit margin of at least 7%. That's your that's what you want, right? I'll give you that, and if there is room for earning more profit, I'll spend that extra profit somewhere else. So I will earn enough profit to satisfy you. That is what profit satisficing is. And if there is room for more profit, obviously there is room for more expenditure as well. I'll spend in research and development. I'll perhaps spend in other ventures, maybe in what's that called? What's that called? That thing? Corporate social responsibility, as CSR. Okay, so profit satisficing, the point is that we ask the shareholders how much profit would make them happy. We earn profit up to that extent, and beyond that, the profits that are there, they get spent in other ventures, for example, in corporate social responsibility or in research and development. Is the concept clear?
Yeah. So the CEO is the one making the profit.
The CEO is the one making the decisions of day-to-day activities in the business.
But the shareholder is making the profit.
The shareholders, they have entitlement to the profit. All the profit that the business makes, it belongs to the shareholders. The CEO and the managers, they just get their salary.
Okay.
The part of their salary to, and you must have studied this in HR, to, for example, motivate the employees of the business. Sometimes we say we have profit sharing scheme. So we say, since you are the ones who are doing all this work to earn the profit, if you earn this much profit, if you meet these profit targets, we will give you, let's say, 1% of profit will be given to the employees of the business. Okay, so that's profit sharing, but they never have the entitlement to it. Like, they never have the ownership over that profit, because if the business makes loss, would the CEO forego his salary? He would still get his salary because he has got that contract with the business.
Yeah.
Okay, so the profit and loss, both, they lie with the shareholders. The CEOs and the managers, they just get their salaries, and part of their salary, as I told you, could be a share of the profit, but it's not mandatory. It could be just to motivate them. Another corporate objective, a common one these days, is corporate social responsibility. So there is a lot of criticism on businesses that you just go about making more profits and you're just exploiting the consumers. You don't care what the society is like, and you don't contribute anything to the society beyond your profit making activity. So this is the new concept emerging, corporate social responsibility, that these corporates, they say, we are not merely here to make money, we are here to make a better impact on society. So I audited the GSK for quite some time. I was over there for 1.5 year. I used to audit their financial statements. So
Wow.
GSK, what they used to do, they operated a few hospitals in Karachi. All right, and those hospitals, they were there in very low income areas, and they used to provide the healthcare and the treatment to people, to the deserving people, free or at very low cost. Similarly, sometimes, for example, a company which makes medicines for the eye, they set up these eye checkup centers, or small stops where people, they can come and get checkup for their eye, which is otherwise very costly. So it's available. Another thing could be, for example, a business which is in the power generation business. Okay, so these you must be aware that these big industries, they are usually situated in the outskirts of the city or outside the city, and in those areas usually there is underdevelopment. So for example, a factory which is located outside a city, they might say that we'll build a road for the nearby village as well. Okay, that road would benefit us as well as the village. Or they might say that we'll open a school in this village. Or they might say that we produce excess power, so we provide the electricity to this neighborhood. All right, so all of these, they count as corporate social responsibility. And the organizations, they increasingly are aware of this fact. They make a mention of all such activities which they have done during the year. They mention those usually in their annual report, which they issue at the end of the year, in which there are the financial statements of the organizations, and along with it they mention what what social responsibility they have taken care of.
Yes.
Clear? Okay. There could These are the common ones, the common corporate objectives. There could be more as well. So, for example, I mentioned the sales revenue. I already mentioned the sales revenue. If an organization goes about maximizing that, there could be a concept of maximizing shareholder value. Maximizing shareholder value. Okay, if you are shareholder of a business, in what form will you get return on your investment? For example, you have purchased shares of Tesla, let's say. Okay, and you bought one share for $35, let's say. At the date $35 per share, you bought 500 shares. So, in what form will you get return on this investment? You made this investment to earn a profit, right?
Yeah.
So how would you earn profit on this investment? You would get return on this investment in two ways. The first one is in the form of dividends. So when a business earns a profit, let's say Tesla made a profit of $40 million in a year. Okay, and then they said that out of these $40 million, we will distribute 25% among shareholders as dividend. Okay, so 10 million will be distributed. So 10 million is distributed among the shareholders based on the number of shares they own out of total shares.
Yeah.
Okay, so that's dividend. That is the distribution of the annual profit that the business has earned. So that is one way you will get return on your investment. So you bought a share for $35 million. Each year you get dividend on your investment. Based on the profits that Tesla is making. The other way you can make a profit on this investment is if share value of Tesla rises. If share value of Tesla, it rises from 35 to, let's say, 45. Even if it's to 36, the share value, if it rises to 36, you're still benefiting from it. But let's say it rises to 45. So now this is called share value appreciation. The second way you get profit on your investment in shares or in a business is when you get share value appreciation. When would share value of a business appreciate? Share value appreciation. When would share value of a business appreciate? So we keep on hearing about these news in the business news section, that share of certain company has risen to this much, market capitalization of this business has risen to this much. So when does share value of a certain business rises, and when does the share value of a certain business falls?
When they make profit.
Very good. One is when a business is making profit and we anticipate that it will make profit in the future as well. If they've made just one-off profit and we have no hope that they'd make in the profit in the future, their share value won't increase.
Yes.
Okay, so if we have anticipation of that they'll make profits in the future, their share value would appreciate. And one indicator that they will make a profit in the future is that when they reinvest some amount in their business. So for example, the 40 million profit that they earned in this year, 25% they distributed as dividend. It means 75% they're doing what? They're reinvesting in the business. Okay, so the more they reinvest in the business, the more the business can grow and the more future profits can be. If they reinvest most of this profit, maybe next year the profit rises from 40 million to 60 million per year, maybe. All right.
Yes.
So these are the two ways the shareholders they get in return on their investment. Now, how does it fit with the topic of corporate objectives that we were studying? It fits with that topic in the sense that a business could have the aim that we are not going to maximize profit, we are going to maximize the shareholder value. So how would we do that? Instead of giving 25% as dividend, we'll give just 5%, and we'll reinvest 95% of that in business, so that in future we are able to generate more profits, and the long term share value of the business, it keeps on increasing. So right now the shareholders, a few of them might be angry who were there just for the short term to earn or to get dividends. They would be resentful that why are they're not paying out this as dividend when they've earned this much of profit. But the business, it might have an aim of earning more profits in the longer term, or it might have that aim of maximizing shareholder value. So it might resort to this strategy. Is it clear?
Yeah.
All right, all right. Now the question is, oh, I deleted all of that. What would be the difference between aims of a big firm and aims of a small firm? When I say firm, it means any corporate entity, any business. Okay. So what's the difference between the aims of large businesses versus the aims of small businesses?
Large businesses would be looking to explore new markets and expand in other countries, while smaller firms are looking for survival.
Very good.
Or at least reaching break even.
Very good, very good, very good. So small firms, when they start their business, right at the start, it's about survival. Right at the very start, they don't care if they make a lot of profit, they don't care if their market share is huge, they just want to survive. Okay, and then from survival, it might change to growth, from where it might change to break even. Okay, or the break even might be there at the survival stage as well, but these are going to be more likely the aims of small businesses, whereas for large businesses it's going to be profit maximization, it's going to be growth, it's going to be market share increase, these sort of things. Another thing, even for large businesses, an industry, it might hit turbulent times, and even for large businesses, sometimes they might get to the situation where their aims could become one out of these. So for example, I don't know if you're aware of that or not, in 2007 there was a huge financial crisis in USA.
Yeah,
many of the big banks, they failed, and the banks which had been around for 100-200 years, such banks failed. Lehman Brothers, there was AGI also, AIG, American Insurance Group, then there was Fannie Mae, and there were many which failed, bear stearns. So such businesses which have been established, which had been earning profits, which had reported millions of profits in just the previous quarter, they failed because of liquidity crisis. So even for industries, for big businesses, sometimes the aims or the objectives they could
Wait,
turn to.
what is liquidity?
Liquidity is the term we'll use more often in the finance section. Liquidity comes from the word liquid. In finance, liquid is how quickly anything can be converted into cash. So cash is the most liquid item.
Yeah. How fast?
How fast anything it can get converted into cash. That's liquidity.
Assets be converted to cash?
Yes. So for example, I've got three assets. Let's say savings bank account. I've got shares and I've got a house. Saving bank account is the most liquid, then comes the shares, and then comes the house. Because I can the most easily out of all these, I can convert savings account into cash.
Mm.
Selling shares would take a slight bit more time, and selling house would take even a little bit more time. So savings account is the most liquid, shares is less liquid, house is even less liquid. Then I use the term liquidation. Liquidation is when a business converts all its assets into cash. Liquidation is when a business actually converts all of its assets into cash. And when would a business do that? When it's winding up, when it's shutting down. So liquidation is another term for shutting down of business or winding up of business. These concepts, just a slight modification. Liquid becomes liquidity, becomes liquidation, but there are different scenarios in which they are used and they have different specific meanings. Got it?
Yes.
All right. So this we have discussed, this we have discussed, this we have discussed. Critical appraisal also we have discussed. Okay, you have your student book, right, with you?
Yeah.
For this book, a rough way of going about is that at the end of each chapter you are given subject vocabulary. So can you open the chapter 1 of this book, go through this subject vocabulary clearly, quickly, and let me know if there is anything which you are okay. The way we proceed with our classes is that I'll teach you at least one or more chapters in each class, and then I'll ask you to read the subject vocabulary. I'll ask you if you have any questions. From that questions you can ask during the class as well. Then it's mandatory that after the class I won't ask you to read during the class. For other students I usually had them read during the class, but for you, I'll have you. The thing is that when I give reading as homework, most of the students they skip it. And the reason reading is important is that most common problem that I've heard from students is that they say, I know the concepts, but I don't know how to write, or I don't know what to write in business. This is the most common problem I've heard from other students. I don't know if it's the same with you or not. Anyhow, the solution to this is to read more. When you read more, your information bank, it increases its balance. Also with reading you develop that idea of how to frame sentences, how to give words to your thoughts. This thing, it comes with reading. So it comes down to you. If you are willing to do the reading as homework, then it's a very good thing. Otherwise I'll have to make you do the reading during the class, but reading is mandatory, it's very important. Okay. I'll give you reading for homework as of now.
Okay.
Okay. The other thing is that if we want to, like, you want to make the best use of this class is to solve as many questions as possible and give me your solutions to check.
Okay.
Okay. That way we'll be both clear whether the things that you have learned, you have understood those concepts or not. The same way I'll give you points on how to score better marks in exam, like how you should alter your answers or how much marks you'd be getting for a particular the thing is that students said that and in business it's very common. Students say that I've written that much or that much, I expect a very good grade, and when the results come, the result isn't as good. The reason is that you think you are answering what the examiner asked, but you're answering, actually the answers that you write mention something else, or they are describing a different thing, or you're
Yeah.
not exactly answering what the examiner asked. So how to decode the requirement of the examiner, number one, and then to specifically write according to that requirement, that is the key. So for that you have to give me a lot of your answers for checking.
Okay.
Okay, so at the end of this chapter 1 there is this Lego corporate objectives exam practice exercise. You can attempt this exercise as homework, and we can discuss your solution tomorrow. Whenever you submit me the solution to these questions, I'll check those and give you answer on those. Okay,
The Lego case study.
the Lego case study.
I already did this.
You have
I like
already
it.
done this? You have already got your answers checked as well by the teacher?
Yes.
Alright, then that's good. That's good. If you want me to recheck those answers, it's fine. We can go ahead as well if you have already got those checked.
Yeah.
Okay. Okay. Then we have got. The next thing. We'll begin it. We won't be able to complete it, but we'll begin it anyhow. We'll complete it tomorrow. I said that to achieve corporate objectives, we have to form strategies. Okay, so to achieve objectives, what we have to do is we form strategies are again not day-to-day plan of what I'm going to do, but it gives me direction of sort of which sort of lines to pursue, or which sort of line of actions to pursue. So for example, an organization,
Like tactics.
tactics is day-to-day activities or the actual tasks that you will do. I'll give you an example. So for example, your organization, it says that we have a corporate aim of increasing net profit by 5% this year. Okay, so to increase that net profit, you are in the sales department, you are given the departmental objective that you have to increase the sales revenue by 25%.
Yeah.
Alright, so to increase that sales revenue by 25%, you said that we will do two things. One, we will explore new markets to sell in, and the other thing we will do is we will make the existing customers buy more. Existing customers buy more. Okay, so these are your two strategies to achieve that aim of 25% more revenue.
Yes.
Got it? And then to sell in new markets, the tactics that you'll do is, for example, you'll do feasibility studies of 3 markets, and out of which you will choose whichever is better. So you will do feasibility study. That is a tactic. Then you will test selling, sell your product on a small scale in that market. That is tactic. Okay, for making existing customers buy more, you will offer loyalty reward program. So you'll offer loyalty cards, and you will have, for example, three, let's say, two Eid sales. Let's say you will have two Eid sales. So around two Eids during the year, you'll offer special discounts. Okay, so these are your tactics, and this was your strategy of exploring new market and make existing customers buy more. Okay, so for these strategies, there is a person named Ansoff. He suggested that the strategies, they can be divided into 4 categories. How they can be divided into 4 categories? You have got based on markets, and you have got based on products. So he said that product can either be new or it can be existing. Similarly, the market can be new or it can be an existing market. So now we have got 4 combinations. The first one is where there is a new product in a new market, and this is called diversification. Diversification, where you're selling a new product in a new market. Out of all 4 strategies, this is the most risky one.
Yeah.
Since the market is new, the product is new, you have less feedback on how things would go about. And then if the product is new, market is existing, we have got product development. If we have got new market for an existing product,
Market development.
very good, that would be market development. And if it's going to be an existing market and an existing product, it would be market penetration. Market penetration is the least risky, but it would involve more resources and the returns are less. The chances of generating a lot of returns on it is less. How do you do market penetration? So for market penetration, you have got market penetration for new products and market penetration for existing products. There are two strategies basically for market penetration. One is price skimming. This is usually pursued with regards to number one, new products or products for which you can develop strong customer loyalty around, or product which offers a lot of differentiation with regards to as compared to the other substitutes which are available. For such we do price skimming. All right. The other one is called what? The other strategy for market penetration is called penetration pricing. Penetration pricing. What do you do in price skimming? In price skimming, you say that what's the maximum anyone can pay for this product. You sell him that product at that particular price. Then you lower the price a little bit, and we know from the economics laws that when price is lowered, the quantity demanded increases. At a slightly low price, there would be a few more customers willing to buy that. Then we will sell them that product at that price. So for each customer, we would be selling it at the price maximum he is willing to pay. Alright, that's price skimming. The risk of price skimming is that the people who get it at lower price, it would offend the people who have bought it at higher price if they get to know it. And that is something that you'll have to manage. You'll have to give them the perception that they have somehow got something better when they bought it at the higher price. The other strategy, which is usually pursued for the generic products where you cannot differentiate your product a lot, or where the demand of the product is highly elastic, that if you try to increase the price, there is a lot of decline in demand. For such products, we pursue penetration pricing.
Yes.
Okay, so these two pricing strategies are used for market penetration. Other than that, obviously you have to do excessive advertisement, and for advertisement you'll have to see the market behavior. For example, the product is for which particular age group and how to engage with them. Shall we keep it till here for today, or shall we discuss?
Also, what about predatory pricing?
Predatory pricing is the same. It's the same as penetration pricing. No, wait. Wait. I'll tell you. Predatory pricing is for with the intent of, that is also sometimes called limit pricing. Predatory pricing is when you decrease the price to kick out a competitor from the market. Penetration pricing is just to get more market share for yourself. Predatory pricing is with the intent of acting as a predator on some other competitor. And predatory pricing, look, in the business it's very difficult to establish that you definitely reduced this price just to kick out another competitor. And even if it's established, it's a very difficult task to build a legal case around it. Okay, I don't exactly know how you're saying that it's illegal. If you could give me a bit more explanation about that.
I don't know, my teacher said it's illegal, or one of the pricing strategies is illegal.
There are a few. For example, price collusion. If you do that, that's illegal. Price fixing agreements. So for example, you and I, we are just the two sellers of shoe in a particular market, and then if we try to compete, I lower price, you have to but lower your price. Alright, if you don't lower your price, all your market share would flow towards me. Agreed? So if I reduce the price, you'll also have to reduce the price, and then you will try to reduce the price lower than mine. So we both sit together, we say that if we keep on reducing prices, this way we'd be harming each other.
Yeah.
So the better strategy to do is, we have an agreement, we will not have our prices fall below this particular amount. So we have price fixing agreement. This is something illegal.
Mm.
This is something illegal because it would exploit consumers. Consumers would, in Pakistan, for example, there are a few sugar producers. There are very few sugar mills. All right, and those people, there are around hardly 25 to 50 people, and the population of Pakistan is around 210 million. How much is it? 210 million. Yes. Okay. So there are only 50 to 70 people big who are sugar producers. What they do is, they do this collusion, price fixing agreements they have got, and obviously, since they have been in business for long, they know how not to set anything down in writing. They just have these verbal agreements.
Mm.
So each time the government tries to reduce the sugar prices, they create an artificial shortage in the market to
Ah.
illegally, and they have the agreement amongst themselves that we will not try to pull leg of each other. We'll, at any case, we will not sell below this particular price. So usual in most of the cases, uh, in most of the countries, such agreements are illegal. These, because they limit competition. All the agreements and all the pricing methods which limit competition in the market, and in that, this limit pricing or this predatory pricing could be covered as well, if it is established that you wanted to kick out a particular competitor just to get the whole of the market and to have the whole market share to yourself. And then, not only to have the whole market share to yourself, then you had the intention that you will have the monopolistic power and you will exploit that power. Then a strong case can be built against you. The another thing I'd like to point out over here, there are three countries in this regard. First, there are countries in which there is no law, and obviously, if there is no law, there is no implementation.
Mm.
So the legal structure of these countries is very weak. The second type of countries are those in which laws are there, but hardly they are implemented.
Yeah.
And the third type of countries is where there are laws and they are strongly implemented. So
Yes.
this also varies from country to country, that first of all, does the country have a law around it or not? Secondly, if there is a law, is that law implemented or not? And third, obviously, if the law is there and it's implemented, then such things would come under the net of the law.
Yeah.
Alright, so we'll keep it till here, and inshallah we'll resume it from here tomorrow,
Inshallah.
inshallah. Okay, see you then, inshallah.
Mashallah.
Assalamu alaikum. Wa alaikum assalam.